Many people believe that building wealth is primarily about finding the right stock, landing a higher-paying job, or finally making enough money to start saving. However, what most people don't realize at 25 is that it's often not your income that's the issue, it's your spending habits. I learned this lesson the hard way. In my early 20s, I was earning a decent income but had almost nothing to show for it. I lacked meaningful savings and investments and was left with just numerous monthly expenses that felt normal, but my bank account barely moved. When I finally took the time to analyze where my money was actually going, I identified 7 specific spending habits that were quietly undermining my ability to build wealth. Once I stopped spending on these habits, my financial situation began to improve significantly. I'm not here to suggest that you skip your morning coffee or stop socializing with friends. That kind of advice isn't the goal here. Instead, I've found 7 spending patterns that consistently hold people back in their 20s and 30s. Almost every one of these patterns is disguised as normal, even responsible behavior. Today, we are going to discuss all 7 of these spending habits, but I want you to pay particular attention to number 6. Most people are currently paying for it every month while genuinely believing it's a smart, mature choice. It's the most expensive item on this list and receives the least amount of discussion. Let's dive in. Number 1. New cars financed from a dealership. This one often surprises people because buying a car seems like a responsible adult decision, and it can be when approached the right way. The problem arises from the combination of buying brand new and financing it. Here's what actually happens. A new car loses approximately 15 to 20% of its value the moment you drive it off the lot. Within 3 years, it typically has lost 40 to 50% of its purchase price. Therefore, you end up paying new car prices for an asset that will be worth significantly less in a very short time. Now, let's add the monthly payments to the equation. The average new car payment in the United States is currently around $700 a month. Over a standard 5-year loan, that totals $42,000 in payments. The car will often be worth more than the loan by the end of the loan. This perspective made me rethink the situation entirely. That $700 a month, consistently directed into a broad market index fund instead of a car payment, has the potential to grow significantly over a 30-year period through compound growth. A car payment gives you a depreciating asset, while the alternative gives you an appreciating one. The practical solution is straightforward. Buy a reliable used car with cash or finance, a used vehicle with the smallest payment you can manage. Let someone else take the depreciation hit. A 3-year-old car will get you to the same places as a brand new one. Number 2. Subscriptions you forgot you were paying for. Research consistently shows that the average American has between 10 and 14 active subscriptions, but can name fewer than half of them without checking their bank statement. This gap between what you think you pay and what you actually pay each month is what I call subscription creep. These subscriptions can include streaming services, cloud storage upgrades, app subscriptions you've downloaded once and never canceled, premium versions of tools you barely use, and even a gym membership from 6 months ago. These individual charges, $8 here, $12 there, feel harmless on their own. However, when added together, they represent a significant amount leaving your account every month without any conscious decision behind them. The goal here is not to cancel everything and live minimally, but rather to make every recurring charge a deliberate choice. One helpful habit for many people is a quarterly audit. Open your bank statement every 3 months, review every recurring charge, and cancel anything you wouldn't actively choose to renew today. The money you free up doesn't have to be complicated. You can automatically move it to a high-yield savings account or contribute it to a Roth IRA, which is a straightforward starting point that requires very little ongoing effort. Number 3, extended warranties and insurance products you do not actually need. Extended warranties are consistently among the most profitable products sold by retail companies. This single fact tells you something important about who benefits from them. The core issue is that warranty and insurance products are priced so that the company selling them makes money on average across all customers. This means that on average, customers pay more for the product than they receive back. There are genuine exceptions, like high-cost appliances known for reliability issues, but as a general rule, aggressive upselling at checkout is profitable for the seller, not the buyer. The same logic applies to certain add-on insurance products. For example, rental car protection purchased through a dealership is often already covered by your existing auto policy or a premium credit card benefit. Cell phone insurance through your carrier may cost more annually than simply paying out of pocket to repair a cracked screen. Gap insurance on a vehicle can often be obtained through your own insurer at a fraction of the cost charged by a dealership. To build better habits, take 24 hours to check whether you already have protection before agreeing to any warranty or add-on coverage at checkout. More often than not, you probably do. Number 4. Purchasing luxury goods primarily to signal status to others. This point requires some honest self-reflection. There's nothing inherently wrong with owning quality items, but it's important to consider why you are buying them. Research into the spending habits of individuals with lasting wealth, particularly the work of Thomas Stanley, which is frequently cited, consistently shows that genuinely wealthy people do not tend to spend heavily on visible status symbols. They often drive ordinary cars, wear unremarkable watches, and live in homes that might surprise most people given their actual net worth. The reason behind this is not that they cannot afford luxury goods. Rather, they have usually stopped caring about the social signals those goods are meant to convey. Status goods are priced according to what they communicate rather than what they do. For instance, a watch that costs a few $100s tells time just as accurately as one that costs thousands. The price difference is purely social. It sends a message to those around you. The uncomfortable truth is that the people you most want to impress with these purchases are often too focused on their own concerns to notice for more than a moment. While quality is truly worth paying for, deliberately signaling your social status with money that could be used to build long-term wealth usually is not. Number 5. Spending driven by the fear of missing out rather than genuine desire. This issue rarely comes up in personal finance discussions because it often masquerades as friendship, fun, and the desire to be a good person to those in your life. However, for many people in their 20s and 30s, it can be one of the most significant and least visible drains on their budgets. Consider destination bachelorette weekends, concert tickets that cost $200 or $300 each just because everyone else in the group was going, group dinners at expensive restaurants where you were uncomfortable suggesting somewhere more affordable, or last-minute flights to events you felt you couldn't miss. None of these experiences is inherently wrong to spend money on. The concern arises when substantial amounts of money are spent, not because you genuinely wanted the experience, but because saying no felt socially uncomfortable in that moment. Before committing to any expensive social event, it's helpful to ask yourself, would I be genuinely excited to attend this if no one in my social circle knew whether I went? If the honest answer is no, that insight is valuable. Spending deliberately on experiences you truly desire is one of the best uses of money. In contrast, spending reactively due to social pressure can silently drain your wealth, especially among younger adults. Number 6, and this is the one I asked you to stay for. Now let's discuss percentage-based financial advisors. This arrangement involves paying a professional a percentage of your total invested assets each year to manage your money. Many people perceive this as a responsible and mature approach to handling savings. For individuals in specific situations, such as complex tax planning, business ownership, estate planning, or those with significant inheritances, a qualified financial advisor can indeed justify their fees and potentially deliver value. For those in the early to mid stages of wealth building, understanding the costs of asset management is crucial. Typically, the standard fee is around 1% of assets under management per year. For example, on a $100,000 portfolio, this amounts to $1,000 annually, and similarly scales with larger portfolios. This fee, compounded over time, can significantly reduce your total wealth. Many self-directed investors now choose low-cost index funds, which have expense ratios below 0.05%, offering broad market exposure at a fraction of the cost. This isn't to discourage working with financial professionals. Rather, it highlights the importance of assessing whether the services provided justify the expenses, especially for those just starting out. Number 7. Emotional spending triggers. Emotional spending can undermine financial goals. It often stems from stress, boredom, or social comparison, making it a predictable reaction for many. Retailers exploit this by designing stores and online experiences to encourage impulsive purchases. To combat this, implement a 48-hour waiting period for non-essential purchases exceeding a set amount, such as $50 or $100. This can help reduce impulse spending without feeling deprived. Establishing a guilt-free spending category in your budget is also effective. Set aside a specific amount each month for discretionary spending to prevent pressure from building up. The goal isn't to eliminate emotional spending, but to make it a conscious choice. Small, consistent adjustments to habits can lead to significant financial improvements over time. Building wealth in your 20s and 30s often involves recognizing what to stop buying. Understanding this early can lead to better financial decisions. If you found this useful, consider sharing it with others. For more topics on savings, investment portfolios, or budgeting, there's additional information available. See you next time.